Welcome back. While our relationship with our largest trading partner remains tense, many are looking for opportunity in China. And while engaging there does make sense, sometimes in some ways, Canada has to be clear about serving its own interests. Fen Hampson is co-chair of the expert group on Canada-U.S. relations. Fen, thanks for being with us.
My pleasure.
So let's start with, on a week when we're seeing China literally lining up with Russia and North Korea, it sounds funny to be saying, how do we do business with China? But it is a massive economy and we do some trade with them already. What's your advice on how to do that well?
Well, Canada is clearly at a crossroads now, Amanda. The U.S., historically our most important trading partner, is shutting us out of its markets. And ensuring Canada's prosperity now means actively diversifying our economic relationships with other countries, including China, which is already our second most important trading partner. And in the report that the expert group on Canada-U.S. relations issued, we argue for a strategy of selective engagement, which means doing business with China, but doing it carefully, doing it strategically, targeting cooperation in areas where it's clearly to our mutual benefit. And that's, selling more to China, particularly when it comes to energy and agricultural exports.
Can we walk that line? I mean, of course, it's a big, compelling market for us, but in terms of protecting ourselves against what can be seen as a hostile state, Fen, do we have the tools we need to protect ourselves?
Well, I think it starts with diplomacy. I mean, there's no question that the Chinese have weaponized trade. They've recently imposed, very high tariffs on our canola exports. And that means, doing a restart on the relationship that starts at the leadership level, which is going to be all important. Prime Minister Mark Carney has already signaled, in fact, he signaled yesterday he'd like to do more business with China. But that's not going to happen until he sits down with Xi Jinping. There'll be an opportunity to do that at the end of October at the APEC summit, perhaps have a sidebar meeting with them. But I think we also have to recognize that it is ultimately in China's interest to do business with us. They're also interested in security of supply. That's true in the energy sector. It's true in agriculture. Their tariffs on canola, Amanda, have led to shortages in China, and prices are going up.
Yeah, hopefully everybody knows that it's in our interest to trade freely or as freely as possible. We don't have a ton of time, but would we be thinking this way about China if the U.S. weren't behaving badly? How much of this is just practicality? We need to trade with somebody.
Well, we need to obviously diversify trade. I mean, I would have argued we should have been doing that before Trump came along. Trump is the latest iteration of greater protectionist policies south of the border. So diversification, and certainly with the biggest market right now in the world, which is China, and we have things we can sell to them.
Fen, so good to have you. Appreciate your time today.
My pleasure.
Fen Hampson is co-chair of the expert group on Canada-U.S. relations. Time for the takeaway and taxing the robots. A proposed new server tax in Alberta is raising eyebrows and questions about how to capture value in a digital economy. The government will launch a 2% levy on hardware in data centers that are connected to the power grid come the end of 2026. There was an immediate chorus of foul play, along with arguments that such a move will hinder investment in a fast-growing sector. And for sure, it might do that, but maybe that's okay. Maybe it's even the point. Back in 2017, Microsoft's founder, Bill Gates, mused about a so-called robot tax. The idea was that as we continue to automate more and more functions of our production of goods and services, human beings will become less and less necessary. Meanwhile, the cost of production after the initial investments in the new robots will fall. So while profit rises, jobs will shrink to nothing. It's a picture that's even clearer now that artificial intelligence is alive and walking among us. Far from just robotic arms on manufacturing lines, AI can replace white-collar workers like lawyers and doctors. Gates' thinking was that taxing the robots helps redistribute income, since the robots are putting us out of work. But it was also clear that slowing down the pace of change was part of the appeal. No one will argue that slowing down the creation of new data centers is a worthwhile goal, if only because what isn't built in Alberta will surely be built elsewhere. But recognizing some of the broader costs of these centers, including the extent to which they will draw down overburdened electricity stores, makes good sense, even if the tax is only used to fund the creation of more electricity. Otherwise, the grandmother in Medicine Hat will be paying exorbitant rates to heat her home so that Google can run its AI through servers hooked up to Alberta's grid. My takeaway? Taxing big consumers of electricity could be only the start of a new way of thinking about where the profit is being generated and at whose expense. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.